it is true that these loans are taken out by people who are often still legally children. They often sign up to these loans before they're 18. And it's also the case they don't always seem to know what they're signing up for. These are very odd loans because the terms can be changed almost willy-nilly by politicians. And this is because they're more like a tax. Just as they can freeze income tax thresholds, they can freeze student loan thresholds. And that is an odd feature of them.
Hello and welcome to the IFS Zooms In. I'm Helen Miller, Director of the Institute for Fiscal Studies. Students are now graduating university with just over £50,000 in debt. The UK has the nice feature whereby student loans are only repaid when you earn enough money to repay them. They are income-contingent. However, student loans are rising up the news agenda and the political agenda because now more graduates are in the situation of facing decades of repaying their student loans. Some of them are making repayments while they're watching their balances grow. There is anger that the system is unfair because the government has changed it retrospectively, and some are saying that the system was missold. So today we are talking all things student loans. How does the student loan system work? How does that vary across parts of the UK? How has it changed for different students over time? Should we think of it as a student loan system or as a graduate tax? Fundamentally, who should be paying for higher education? To discuss all that and much more, I'm delighted to be joined by Nick Hillman, who is Director of the Higher Education Policy Institute and, importantly for today, was an advisor to the government back in the early 2010s when they were introducing the so-called Plan 2 student loans, and by my colleague Kate Ogen, who is a specialist on all things student loans here at the IFS. Welcome to you both.
Thank you.
So, Nick, I want to start, before we get into the details of Plan 2 and Plan 5 and all of the nitty-gritty, with the kind of broad sweep of student loans. We've come a long way from the days where the government used to fund all of higher education. Now they don't. And I think actually looking around the table, each of us have been through a different student loan system. So paint a picture of us. How would we get from a fully government funded to what we've got today?
Well, many, many years ago, of course, very few people went to university. So it wasn't unreasonable or unaffordable for the government to cover the costs, even though most of those students came from pretty well-off backgrounds, typically. The era of completely free higher education was much shorter than most people think, because there were means-tested tuition fees until the late 70s. And then my cohort, I went to university in 1990, we were the first to face loans, maintenance loans, not tuition loans, maintenance loans. And that was really because the number of students had grown. And also a feature we have in Britain to a much bigger degree than most other countries, which is we typically go to university a long way away from where we grew up. And so our maintenance costs are much more expensive. So we actually had loans for maintenance before we had loans for tuition, but the tuition fee loans sort of inevitably came along as well when the sector grew even more, with the first tuition fees in 1998, though those ones had to be paid up front. And it was only in 2006 when you started out getting fee loans as well as maintenance loans.
Yeah, so I think I did my degrees in the first one in the mid 2000s and then one later. So I think I had some student loans I should look back and find this out. I had some student loans for the actual fees, but they were much lower than they were nowadays. So up until 2012, is it, when the Plan 2 came in, even when there were loans for fees and maintenance, they were still relatively small.
Yes, that's correct. So the really big change, which is still the same underlying legislation that we have now, was the Higher Education Act of 2004, which took effect from 2006, and that introduced £3,000 fees. And when I was working in government in the early 2010s, and we tripled fees to £9,000, it was still using the same underlying legislation that Tony Blair and his colleagues had implemented back in the 2000s. And then the fee loans rocketed. And of course, in 2016, just after the 2015 general election, maintenance grants were abolished, which also led to another bump up in how much people borrowed, because they had to borrow all of their maintenance costs if they're from a poorer household, and obviously if their parents couldn't afford to contribute towards the maintenance loan. So there was another big bump up in 2016.
We should focus on that point just for a second, shouldn't we, Kate, on the maintenance grants versus loans, because as Nick said, people who move away have to pay to live somewhere different. But there have been periods where there have been grants that you just get given if you're on a low income and don't pay back. So we went through a period of having those, but we focus more over time on you borrow to pay for those living costs.
Yeah, so up until 2016, if you were from a lower income household, you could take out a loan, but you also got a grant from the government. And that meant that people from lower income households tended to borrow less than those from better off households, some of them. Since 2016, the abolition of maintenance grants, now it's people from the lowest income backgrounds who tend to borrow the most. So they can borrow more for their living costs and they tend to graduate with more debt as a result.
And another thing else we should highlight up front, because I think we're so used to it, we'll sort of forget it as we talk about it, is that we have income-contingent loans, and that hasn't always been the case. We used to have these mortgage-style loans. So just tell us a bit about that now.
Yeah, so my loan, when I went to university in 1990, for my maintenance costs only, was a mortgage-style loan. And those were meant to be repaid over 5 years normally, after you had left university. So you paid equal payments over 5 years. They were income related in the sense that there was still a minimum earnings threshold you had to be at in order to start paying off the loans. And that, I mean, they've pretty much gone, those loans, but there is still in theory a repayment threshold for those loans, which is now £41,000 a year. So it's very, very high. But very few, those loans are basically now gone. And they were deemed inappropriate because although once you're over the earnings threshold, you basically just had to pay back the same slugs of money each month, each year. And they was deemed sort of not sufficiently sensitive to people's earnings. And so income contingent loans, are very unlike other forms of loans like your credit card or your mortgage or the student loans they have in some other countries. Yes, there's the earnings threshold, but then you pay 9% of your income above that. And the earnings threshold is higher than the earnings threshold for income tax. And if you lose your job or you take time out of the labour market or you reach the end of the repayment period with debts, then the repayments stop.
And that's, again, before we get on to all the nitty-gritty, which we will, I think it really helps think about what these loans are, right, Kate? Because they come with this kind of insurance. So if you are somebody who comes out of university and you earn lots of money, you will repay your student debt. But most of us don't know exactly what we're going to earn when we come out of university, obviously. You don't know what your lifetime earnings will be. So the loans we have come with this insurance where if you don't earn enough, either in a given year or over your lifetime to repay it, you won't repay it all and it'll get written off at a certain point in time. This is why we had this debate about whether they're a loan or a graduate tax. So talk us through when think of it as a loan, when think of it as a graduate tax.
So if somebody can expect to repay it in full, then how much they're going to repay is going to depend on the interest that's added to the loan while they're making repayments. And in fact, interest is added to these loans while people are still studying as well. That means for these people who can expect to repay them, they're more like a loan. The interest matters, the balance matters, and they will kind of repay the full amount. But for lots of people who won't fully repay these loans, they act more like a tax. So the amount they repay each month is going to depend on their income. But many people will kind of continue to pay these as long as they're earning or until they reach the end of the repayment period when the rest is written off. So for these people, it's much more like a tax.
For those, it doesn't matter what the interest rate is, does it? Because their loan is going to be written off. They could have 1,000,000% interest. It would make no difference because they've still got an outstanding loan at the end of the repayment period. And the repayment period's changed over time, but it's 30 years for the Plan 2 students.
I think one of the issues where people find it stressful to have these large loan balances is because you don't know exactly which category you're going to be in. So as you said, Kate, if you know for sure you're going to pay it off, you can think of it like a loan. You might want to repay some early and kind of get rid of that loan quickly. If you know for sure you're never going to pay it off, it's just a graduate tax, but you don't know which category you're in.
But in a way, that's the beauty of it. When I buy my car insurance, I don't know if I'm going to have a car accident and have to claim on it or not. When you enter the labour market, you don't know if your career is going to work out or not. So it sort of works like insurance. It's an insurance if you lose your job, you never get well-paid work, you have a disability and can't work. So these are the insurance features that have to be paid for. They do increase the cost of the loan. It's why the real interest rate is there, but it is a useful feature. Talk to people in America. When we were devising the Plan 2 loans, I went over to California with my boss, David Willett, and we met some of the students at the University of California who were protesting against the American loan system. And these were deemed the radical students. And they were arguing for a system that looked very like the one we were implementing in Britain that was leading to students rioting on the streets of London at the time. But these are some progressive features.
And actually, having seen, I have an American husband, and therefore having seen my student loans and his student loans, and he basically has a mortgage-style student loan where it doesn't matter how much you earn, you basically start paying back big repayments, very aggressive, very early, as opposed to here where even if they feel high, you have to earn a certain amount of income before you start paying, and they're income-based. So, worth remembering there are the different systems out there, and some of them don't have this insurance feature where you could have no job and it's still you have to keep paying.
Yeah, and some people, of course, have argued that the British system should become completely like a graduate tax. But if it was like income tax, for example, the repayment threshold would probably be much lower than the 28,000 or so it is currently. And it would just be a different sort of beast.
Let's talk about some of the details of a specific set of loans, because we've mentioned they've changed quite a lot over time, from the government pays for most of it to the small loans, small maintenance fees. Plan 2 is when it all kind of changes more directly. So perhaps first, Kate, tell us what Plan 2 is. I'm going to ask you, Nick, what you were thinking when you were implementing Plan 2.
So Plan 2 loans were issued to students from 2012 onwards. They're still issued.
You're a Plan 2.
I'm a Plan 2. So I've got a Plan 2 student loan, as do most people I went to school with have a Plan 2 loan. And they have 3 key terms. So one is the repayment threshold. That's the income above which people make repayments. That's about £28,500 currently. The second is that interest is added to the loans. While people are studying, that's the RPI plus 3%. It's then at
RPI is a measure of inflation, we should tell people. So
yes,
it goes up by prices, or at least a measure of prices, plus another 3%.
And then after people have graduated, it goes up by between RPI and RPI plus 3%, depending on how much somebody earns. That's quite an unusual feature of a loan. So I'm interested to hear why Nick put that one in. And then the third thing is the write-off period. So after 30 years after graduation, any outstanding balance is written off at no cost to graduates. So that's the kind of Plan 2 system.
Right, so Nick, tell us, what was the thinking behind the Plan 2? Because it was a big sort of break with what had gone before.
Yeah, it was a huge shift. So the first thing you have to remember is the politics of the time. So it was just after the 2010 general election, and every big political party at the 2010 election had promised big cuts, because it was just after the big financial crash. And they'd said, all the political parties, they were going to protect some areas of public spending, which meant the unprotected areas had to have even bigger cuts. And at that time, higher education was in the business department, and so the business department was in line for really big cuts. Now, the business department's really big spending in relation to universities was on research, which again was a protected area, so there weren't going to be any cuts to research, and teaching and learning. And we felt we had 3 choices. We felt we could either cut the number of students significantly to save costs, which we didn't want to do. We felt we could hugely reduce the amount of money spent on each student's education, meaning a much less good experience, which again, we didn't want to do. So we felt we only had one choice, really, which was to expect the main beneficiaries of higher education to contribute more of the costs. So keeping, as I say, the Blairite settlement, but sort of putting knobs on it, if you like. And we also had a report, the Brown Report, which was a cross-party report in the sense it was endorsed by both Labour and the Conservatives, set up by the previous Labour government, this man called John Brown, who had written a report for government which made a set of recommendations. Now, it didn't make the exact recommendations we went for, but they were similar. So in terms of the interest rate, Lord Brown recommended 2.2% plus RPI. We went for 3% plus RPI. And the reason we went for 3% was there was a view that there should be a certain level of redistribution within the system to pay for the insurance elements. So it was felt that it was reasonable to expect the really best paid graduates to pay a little bit more than the cost of their education. The government cost of borrowing at the time was determined to be 2.2%. So that's why Lord Brown had said the interest on loans should be 2.2% plus RPI. We went for 3% plus RPI. So just a smidgen more to try to make sure the best paid graduates didn't exit the system really quickly, and to help cover the cost of some of these insurance features. And remember also, I was a political advisor of the Conservative half of the coalition. But remember, we were in government with the Liberal Democrat Party, and they were particularly keen on some of the more progressive elements of the package. So the real interest rate is one of those. They're also very keen at an issue I'm sure you'll want to bring up on making sure the repayment threshold, which was originally set at £21,000 a year, would go up every year in line with earnings. So those are the sort of ways the Liberal Democrats helped shape the package, even though they were the minor partner in the coalition.
We'll come back to the repayment threshold, because that's been sort of controversial recently, but I think it's worth spelling out to people kind of what this plus 3% is doing in a sense, because you might think that you take people, they take out a certain amount of debt, you basically make them pay off that index for inflation. So money becomes less valuable over time, just the plus RPI. The plus 3% is what, as you said, is giving you some progressivity in a sense, because you're saying there's going to be some subsidy in the system. You're going to have to pay for the student loans that aren't repaid. The people who don't repay them are going to have to, someone's going to pay for that. So basically you're taking graduates and they're repaying more than they borrowed. They're paying that bit extra. And that's what's going to cover in part the subsidy for the students who go on to need the insurance to not get enough income.
100%, that's right. But there was still a very significant government subsidy in the process, because when the system was designed, we didn't expect 100% of the money loaned back to come back in, because even though the high earners was paying a little bit more than the cost of their education, many lower earners were getting nowhere near covering the cost of their education. And as I said, back in 2010 to 2012 period, when we were designing the system, we kept maintenance grants. So that was another subsidy into the system. And of course, it's been mucked around with so much since 2012 that the Plan 2 loans today look rather different to the Plan 2 loans when the system was first implemented.
So we're going to come back to that, but I almost want to just focus a bit on this, and Kate knows I've got a bit obsessed with this plus 3 thing. I think it's an interesting... So I think what the choice means is that to the extent that you're getting the graduates to pay for part of the subsidy, as you said, it's going to be kind of those graduates that are in the Plan 2 system. It's not graduates like me who were in a previous system who could have gone on to earn money. And in some ways, it won't be... And I don't know empirically if we know how many people this is, but it won't be the graduates who got a Plan 2 loan, expected to repay it, or and therefore repaid very quickly to get out of paying the 3%. So it's being paid by the graduates who had a Plan 2 loan and paid and kept paying for a long time. So it's not all graduates. I think that's what I'm saying.
No, it's still the case, of course, that if you're a very well-paid graduate, you extinguish your loan quite quickly. So the 3% affects you a bit less than if you pay it back much more slowly. If you're a doctor rather than a teacher, let's say. We could have gone for 5%. We could have gone for 10%. We could have gone much more redistributive, but we didn't, partly because we thought what we did was fairer, and partly because we were walking a very tight line, because one of the things governing us were the accounting rules. And if what we did looked much more like a tax and much less like a loan, then the risk was the Office for National Statistics or someone else would come along and say, this has all got to be on the government's books. And in the national accounting rules at the time, none of the loans appeared on the books, whereas all of the grants did. But if the loans had looked like a tax, then it would have scored in the national accounts completely differently. Remember, the key driver here was the austerity cuts that the Treasury insisted we did, and which we believe the electorate had voted for in 2010.
We should say here the way these loans are treated, the accounting way these are treated on the public finances has changed in a really positive way. So when these loans were brought in, when they were the kind of write-off of them at the end of the 30-year period was going to show up on the books in 30 years.
As a cost at that point, you just lost something. Yeah.
Now the ONS accounts for the cost of the loans and the bit that isn't going to get repaid up front. So when these loans are paid out to students, the government estimates how much it's going to get back in repayments, and the bit that it's not going to get back, it treats as spending when the loan's issued. So that avoids some of these incentives for government to fiddle things to
and I agree the system we've got now is probably better. But what would have been really dangerous, I think, back in 2010, would have been if the government had said, we know better than the international accounting standards. We're going to classify loans how we choose them to. So people might say, why did you let the accounting rules drive the policy so much? But you don't, in my view, want politicians setting the accounting rules. You want the policymakers of the day to reflect and respond to the best accounting rules as they're currently in place. And that's what we felt we were doing.
So we've talked about Plan 2 as they were envisaged. You've already mentioned, Nick, they changed quite a lot from the plan that sort of you thought you put in place. Kate, talk us through maybe not all the gory details, but the kind of the major changes in the... How's it different now to what you signed up for?
So most of the terms of the loans haven't changed. So the interest rate was always going to be between RPI and RPI plus 3%. The repayment period was always going to be 30 years, and the rate was always going to be 9%. So those things haven't been messed with. The things that have changed are the thresholds in the system. So the repayment threshold, this thing that's currently 28,500, and the interest rate thresholds. So the income levels between which people get RPI and RPI plus 3. Now, the history of this is pretty complicated. Various governments have tinkered with these. They were initially set at 21,000, that repayment threshold was. It was then going to be frozen, but Theresa May got so much flack for this, she actually increased it from 21,000 to 25,000 in 2018, so it increased by more than people expected. It then did increase with average earnings for a brief period. Then it was frozen again from 2022. Then it has been unfrozen for a couple of years. It's now going to be frozen again for 3 years from next year. So this repayment threshold, if you draw it on a chart, it looks ridiculous.
We should point out, but basically freezing here means that students will pay more in real terms. They start paying sooner. And then increasing the threshold is sort of good for students because you have to earn more before you start paying. So freezes here are costly for students.
That's true for most students. Now, if you're one of those very highly paid graduates who is going to pay it off and paying it off more quickly is good for you, actually, with a lower repayment threshold, you might pay it off quicker and with less interest. Those students can choose to overpay if they want to.
Okay. We should mention, we're jumping around a bit, we should mention Plan 5 because, so we talked about Plan 2 has captured imaginations, possibly because I guess there are now more MPs and journalists who are in this system themselves, and they're now facing it. It's real. People are now, they're going to work. Maybe they're facing their 40p income tax, and they're facing their 9p in the pound graduate tax. So it's more salient for more people, I think, now. But for current students who are going to university at the moment, they're not in Plan 2. They're in Plan 5.
Yes, so from 2023, new English students have been issued with Plan 5 loans. The Plan 2 loan still exists for past students and are still issued to Welsh students. So these new Plan 5 loans are different in a few important ways. Firstly, the repayment threshold is a bit lower. It's currently £25,000, although by the time both these thresholds have been unfrozen, by the sort of end of the 2020s, they'll be almost at the same level. So that won't be a difference so much going forwards. The other two important differences are the repayment period is longer. It's 40 years instead of 30. So people might pay this for up to 40 years.
To base their entire working lives.
Yes, yeah. But the really important difference for most people is that the interest rate is much lower. So it's just RPI. It's never RPI plus.
So you're never repaying more than you borrowed in a sense in real terms. You take out an amount of money, you repay that. This progressive element that you talked about introducing, Nick, has gone.
Yeah, and so it sounds, Plan 5 loans probably sound better to people because the single most unpopular feature of the system under Plan 2 was the real interest rate. But actually, a lot of people will pay more under Plan 5 than under Plan 2. And that is because, as Kate says, the repayment period has gone up to 40 years. So under Plan 2, if you haven't paid off your loan by 30 years, it gets wiped out, however much money's left. Under Plan 5, it's 40 years. And there are people around at the moment who don't like the Plan 2 debt they've got. And they're saying, why not let people shift from Plan 2 to Plan 5? I think that would be a very bad decision for some people to do because, as you say, they'll be repaying, depending on what happens to pension ages, be repaying for pretty much their entire working life. And when the old government moved from Plan 2 to Plan 5, actually a lot of people on the left of politics opposed that move. And as Kate says, the Welsh Labour government kept Plan 2 because they felt Plan 2 was more progressive than Plan 5. And I think one of the really interesting things that's currently going on politically is a lot of the criticism of Plan 2 seems to be coming from the political left, whereas actually what they're opposing are some of the most progressive features of Plan 2, like the inbuilt redistribution. So it's a very interesting moment. I mean, we may end up with Plan 6 because the Welsh government has said they're not going to implement the freeze in the repayment thresholds for Plan 2 in England. So Wales will then have different repayment thresholds to England. And then we may end up with Plan 6. And I think eventually someone might have to have a look at all of this and, you do what they did years ago with pensions tax, where there were 8 different pension tax regimes, and take it all down to one. At some point, this is going to get so complicated, the student loan companies' computers will, blow up.
Well, it's also complicated. I mean, I'm impressed that you guys are remembering and I'm this detail, because also we've sort of skirted over that. Yeah, well, you mentioned it varies in Wales. It's different in Scotland. There were Plan 3 and 4s that we've sort of skirted over. So actually, there's just a lot of complexity in this system. So it's going to be hard for people to. I mean, if anyone's like me, they probably think of the student loan system as the one that affected them, maybe the one that affects their kids. Keeping up with what's happening here actually is quite difficult. It's part of the political problem that everyone's got a different version of the system in their mind when they're talking about it.
Yeah, it makes it really hard for people to understand. It makes it hard actually for government to run the system. I mean, when we were implementing Plan 2s initially in the 2010 to 2012 period, the Treasury wanted the new system to start in 2011. And we said you simply can't do it that quickly. You've got to tell young people the system they're on, and you've got to let the student loans company implement it and roll it out. And so I don't think anybody would claim what we've got is simple or explicable. And indeed, we did some polling recently among students, and we said, how well do you think your schooling prepared you for higher education? And the top finding from that was that they would have liked more financial literacy education, in PSHE or whatever, at schooling, because they got to university, found they were financially independent, and weren't ready for that. And there are 2 issues here, I think. I mean, we spent most of the session so far talking about graduates, but then there's also the issue of what happens while you're a student. And at the moment, students are really struggling with the cost of living. So that's another issue that needs to be on policymakers' radar.
And I worry about, so people making the decision about whether to, or not to go to university. I'm seeing lots in the media at the moment about student loans and people who are, burdened by lots of debt. And that's not particularly helpful, I think. Given many of these students won't be on the same loan type. So they're kind of, these loans, they'll never get one of these loans. They can't get one of these loans. But it's kind of talking about it as a burden of debt when these aren't really normal loans like that.
Yeah, and I think we do have to recognise the people kicking off at the moment about the Plan 2 loans tend to be members of Parliament who are on very high salaries, doctors who are on very high salaries, and it's no accident that they're the ones kicking off, because they're the ones who face RPI plus 3%. The people in much lower paid work don't face RPI plus 3%, as Kate has already explained. So, it's an interesting moment that is people getting in well-paid early Plan 2 graduates getting into well-paid positions of influence and using those positions of influence to criticise the system. But they've got to say what a better system would look like if they are really unhappy with the ones we've had.
Yeah, but also worth highlighting to help people get their minds around this, what we talked about earlier. So they're not just the ones that are higher paid and paying back, but they're in that situation where actually they might face paying back their entire loan. So as Kate said at the start, for them, actually, it is the interest rate that matters, because that will determine how much they pay off. Whereas there'll be lots of people who actually, for them, the interest rate is irrelevant, because they'll pay their 9% until it gets written off. It's like a tax. They really don't need to care about it. So they might, you might see this big balance. Your balance might grow for a long time, but that's for many people not the relevant feature. It's just the 9% that matters.
Yeah, it's true. That's true. But if we're looking at how progressive or regressive or how well it works, we're thinking about student finance in the round. We also have to remember that half the population don't go to higher education. And often those of us working in higher education produce these charts showing exactly which graduates are doing better or worse than exactly which other graduates. But for half the population, they don't get to set foot in a university and get the benefits of higher education. And the half of the population who do go to higher education, typically, not always, but typically are on significantly higher salaries than the half who didn't go. And they're much less likely to be unemployed. And of course, we know that unemployment early in your working life has a dramatic long-term impact on your entire career trajectory. So we've got to remember that by and large, this is a conversation entirely about the half of the population who've had all those benefits from higher education, some of which are financial and some of which are not financial.
And we'll come back to the issue about what's fair, because I think the fundamental question underlying all of this is who's going to pay for higher education. And is it going to be the graduates themselves, other graduates, other higher taxpayers? Does it include the people who don't go to university and all that? But let's park that. You mentioned that from the survey you did, some students, some young people would like more information. There's a big debate going on right now about whether these plans were missold, whether people at the age of 18 were making well-informed decisions is part of it. And then the other part of it as well, maybe you made a good decision, but now the government's changed the rules of the game. So, I mean, what's your take on that, Nick?
Well, I don't think they've been missold because, as I say, they, by and large, went to higher education, enjoyed their experience and have done very well after it. However, it is true that these loans are taken out by people who are often still legally children. They often sign up to these loans before they're 18. And it's also the case they don't always seem to know what they're signing up for. These are very odd loans because the terms can be changed almost willy-nilly by politicians. And this is because they're more like a tax. Just as they can freeze income tax thresholds, they can freeze student loan thresholds. And that is an odd feature of them. However, we live in a democracy. And, that's why it's kicked off recently. People can vote for these things to be changed. And, of course, the country is not as rich as we thought it was going to be in 2026 when the system was designed back in 2010. And we've had multiple different colour governments as well who've come in with different priorities. So I do understand why people signing up to a loan where you can change the terms willy-nilly feels uncomfortable. But then the other partner on the loan is the government. It's not a private bank. So it is a different sort of beast.
It's definitely this changing of loan terms that's got people upset, I think, at least in parts. You mentioned, Kate, that actually most of the terms haven't changed. Actually, it's been very stable since Nick was back there designing them. But this threshold has changed. And Martin Lewis, as an example, who does lots of consumer rights stuff, was on record after the Chancellor in her budget recently changed the threshold, basically saying that it was fiscal drag and he didn't think it was the moral thing to do, highlighting that a commercial company would never be able to change terms like this. But of course, as Nick said, if you think of it like a tax, we change taxes all the time. We don't have taxes that are set in people terms for set in stone people's lifetime. So there's a tricky one here between whether you think of it as a tax or as a loan and what the government can and can't change.
I think that partly the difference here is that you sign up for one of these loans. So when you take one of these loans out, you're asked to sign up to terms and conditions, and you make a choice in a way that you're not asked to sign up to a future income tax threshold. No one's made a sort of commitment to you about that. No, but I went back and looked at the loan terms I signed up to. I thought that would be a useful exercise. I went back and looked, and it has a line in it that says something like, but the regulations can change, so these terms are, subject to change. You can't write one of that into a normal commercial loan
It's also
contract.
worth just saying quickly, though, they don't always change in a way that's worse for the students, right? So they have changed in a way that's been better for students, and no one's upset about that. So there's a bit of an asymmetry here as well.
100%. So I was there actually chairing an event that Martin Lewis was speaking at the Conservative Party conference in 2017. So just after the 2017 general election, where Theresa May thought she hadn't done as well in that election as she thought she was going to do because of how young people had voted. And so she announced at that party conference both the establishment of what became the Auger panel that reviewed the whole system, but also a big one-off increase in the threshold from 21,000 to 25,000. And all those people who had been complaining about retrospective changes suddenly didn't mind a retrospective change. So we have to remember that the changes can work, as you say, in favour of graduates if you think a higher threshold is what they want, as well as against the interests of graduates. It can work, it can work both ways and has worked both ways in the past. And so I don't think this is moral or principle, because remember, when it changes in favour of graduates, the generality of taxpayers normally then face a bigger hit, including all those people who didn't get higher education. So it's not a one-way bet. Somebody loses if graduates are going to pay back less.
Although, interestingly, when Scotland moved, we're going to mention one of the other plan numbers here, when Scotland moved from a Plan 2 to a Plan 4 system with a much higher repayment threshold and a lower interest rate for its loans, it moved all of its existing graduates from the old plan to the new plan. And it said, the new plan's better. We want all of our graduates to be on the new plan. So that is also an option. It would be to move people between plans.
Well, I suspect the government might have a much harder time moving graduates to a worse plan. If they said, no, we've got a worse plan, it's not as generous, we're going to move you all to this plan, I suspect that wouldn't be a politically viable. Giving people stuff is always easier, right, than it is taking it away.
It's a very good question, isn't it? What's a worse plan and what's a better plan? Because some graduates want to extinguish their loan as quickly as possible. And actually, that would mean you've got to pay back a bit more, but the loan is off your back quite early, whereas others want to string out the repayments as long as possible so they hit that write-off period.
But if somebody wants to pay more, they can choose to pay more. So that option's still on the table for them if the repayment threshold's higher.
So before we wrap up, let's talk about fairness, because I think it's at the heart of the kind of debates we're seeing. I think it's the heart of the debate we're going to see keep kicking around. I think sometimes the important point here is that there isn't fair and unfair. It's partly in the eye of the beholder. Someone's going to pay for higher education. The underlying fact here is that higher education is quite expensive, partly because you're moving away from home, partly because you're giving people lots of education. And then there's different measures of fairness between maybe graduates and taxpayers, where taxpayers will include people who haven't gone to university, between, graduates in a certain cohort, maybe graduates, like Kate and I are different cohorts, we're both graduates, how do you think about us? There's issues between generations, there's issues about whether terms have changed respectively. So all these different dimensions of fairness are in there. I mean, Nick, you would have faced these issues back in 2012. Obviously, you made a choice back then, but going forward, how do you think we navigate these issues? But there isn't a fair. There's just different people who have different views.
Yeah, and that's why it's really important we have these sorts of debates. These are constantly live issues. There's the intergenerational inequities. People feel they're paying more than the cost of their education back, so that pensioners can have lots of freebies. Is what some people think. There's another angle as well, which I don't think you had in your list, which is international students pay very high fees and are now cross-subsidising the costs of home students, and indeed the government's about to whack an additional levy on international students, and that money will go into government, in theory, to repay for the reintroduction of maintenance grants, but it's going to raise a lot more money than they're going to spend on the new maintenance grants, which have very limited terms and conditions. So there are all sorts of, you're right, I mean, this is about fairness. Back in 2010, as I say, what drove it was the politics in the election of 2010, and we felt the system was fairer than the main alternatives, sending far fewer people to university, for example. And the reason I am still perhaps the biggest supporter left of the system we implemented is that it allowed us to do something incredibly important, which was remove student number caps. So before we implemented a Plan 2 loans, every university in the country was restricted in how many students they could recruit. So there was also a total cap on how many students could be recruited. And if universities over-recruited, they got very significant fines. So my first job in higher education policy back in 2007 was calculating how many people were applying to university and having the door slammed in their face. So people who were good enough to go academically and whom the universities wanted to let in, but were having the door slammed in their face. And on some numbers, that was hundreds of thousands of students. It was certainly tens of thousands of students. So we've got to remember the other fairness here is if you were really generous towards students and graduates, there'd probably be fewer places. And indeed in Scotland, where they don't typically have tuition fees for home students, the number of places at Scottish universities for Scottish domicile people is very strictly constrained. So that is another fairness here, is about how many places are there in the system.
So I think we should pick up on this fairness point, Kate, that I think often gets mentioned in news reporting, is that there are some graduates whose families will pay off the loan, perhaps not pay it up front, but at some point pay it off. How do you think about that in the fairness debate?
I think it's a difficult one. So if somebody can pay this loan off quickly or perhaps never take it out, then they are able to escape the above real interest rate, the above inflation interest rate. But partly I think what bothers people about this is actually just that some families have £50,000 and some families don't. So I think it's tricky sometimes to say, is this an issue with the loans being unfair because some people can escape them, or is it actually a kind of broader problem of wealth inequality that's really bothering people?
Another aspect of this, Nick, is that there are some people who are not taking out loans, not just because they're rich, but because they don't want to take the loans out per se.
Yes, so I regularly read that something like 10% of the population pay their fees up front and manage to escape the whole system, which is a feature. But I mean, there's a certain proportion of the population that don't buy their cars on hire purchase, don't need a mortgage. It's just the fact that some people are richer than others. But the reason I am worried about that number getting currency is there's also a small proportion of the population, particularly with Muslim backgrounds, who don't believe, for religious reasons, that a real interest rate on student loans is appropriate, and have therefore, scrimped and saved every penny to avoid taking out student loans. And there's been a long commitment to introduce a different form of student finance for people in that position, which has taken literally years and years and years to get off the ground. But we shouldn't forget that some people who are not taking out a loan may not be old Etonians, may be people from tougher backgrounds.
Another reminder that there's lots of different things going on in this system.
And the other thing to remember on people paying up front is the Treasury likes people paying up front because it means there's
money
no
today.
risk. Money today. And if you go back, as I did over the weekend, and look at some of those old reports, the Brown report, the Auger report, the Deering report, they were very cognizant of that. And the Treasury doesn't want to lend money to people who don't want to borrow it.
It's another illustration of the choices government have to make. I mean, how do you think it's going to pan out, Kate, with this issues about fairness? Because there isn't an answer here. There's not one system where everyone's going to say it's fair. And however you change it, some people win, some people lose.
There isn't. I think one reason this is in the news so much is that more of the people who went to university in 2012 and were the first to face the higher fees in the new loan system are making substantial repayments now and seeing how that's going to play out over the rest of their lifetimes. And they compare themselves to the people who went to university a year before them, and they say, oh, wow, this is actually going to cost me a lot. And I think we'll see that again when the people who are on at the end of the Plan 2 or the start of the Plan 5 system, in 10 years' time, will be in the same position with those people. And the highest earning Plan 2 graduates will be saying, I'm going to pay, £20,000 more than my mate who was in the year below at school and went to university a year later. So I think these issues kind of will bubble up again as more and more people compare themselves to really very similar people who got the same product.
Yeah, I agree. It affects people in very different ways. I mean, I was chatting to someone at the weekend who's an English person at a Scottish university. So they're paying 9k a year or so to be there, sitting alongside people who are paying nothing and sitting alongside international students who are paying very much more. So the system does work in odd ways. But I think one of the odd things about the current furore from Plan 2 graduates who are now getting on in their careers is they complain they're paying a marginal tax rate of 51%, very often 40% higher rate tax, 2% national insurance, 9% student loan repayments. Now, that is high. Nobody likes having more than half of their salary taken out as source. Nobody likes that. But it's not historically high. It's not unprecedented. Many of the people who are now pensioners faced a much higher rate tax than that before Margaret Thatcher cut it back, for example. People who are on benefits face much larger benefit withdrawal rates sometimes than 51%. So I totally accept that I don't like having more than half my salary taken out of source. No one likes that. But it's not unprecedentedly high in historical terms.
Although it's also the case, isn't it, that it interacts with a broader context here of the threshold freezes. So now that the higher rate threshold is kicking in at a point where many more people and much bigger shares of earnings will be subject to that. So it's true that the top rate has been higher, but actually just more people are in a situation of being higher rate taxpayers.
Yeah, that's true. And the IFS work on exactly how that hits people in the pocket is incredibly important here. And it makes a much bigger impact freezing a threshold than people might think, which is why the Treasury loves it. And of course, the other feature here is we've had very big increases in the national minimum wage and the national living wage, which means they are now bumping up against the threshold. And I think most people think, and I think I probably agree with this, that if you're in national minimum wage type work, then it's slightly odd that you're in a repayment system for a progressive student loan system. But then there are other features as well where the government saved money, which are also problematic. For example, the threshold for parents expected to contribute to their students' living costs is £25,000 a year. So if your household income is less than £25,000 a year, more than £25,000 a year, expected to contribute towards your students' offspring. It's been £25,000 since it was introduced in 2008. And I don't think most people would think £25,000 these days for running a household is an extraordinary sum of money. And yet they're being expected to contribute as well. So another group, when you think about fairness, is the parents of students being expected to pay.
So my final question, I mean, it's an unfair one, but what do you think is going to happen? I mean, I read a quote, I can't remember who from now, the other day, basically saying there's just so much upset with the system. There's so much confusion about it. There are these people on boundaries where they're comparing themselves. Something has to change. Are you in that camp, or do you think actually we could just keep Plan 2, keep Plan 4 and have another Plan 5 at some point, Nick?
Well, I mean, this government has a reputation for changing its mind. So I don't think it's completely beyond the realms of possibility, they might look again at the thresholds. They might set up a review of the great and the good to look at this. I mean, my old boss, David Willits, who was the minister at the time, has said there should be a quinquennial review. He said every 5 years, a group of experts should come together to look at all the parameters to see if they're reasonable, see how much taxpayers are paying, see how much graduates are paying, and to make recommendations to government the same way the national insurance used to work. That's not unreasonable. Though I went back at the weekend to the Deering report, the Brown report, and the Auger report, which all have big sections on this. So you might also argue the great and the good have already looked at this many times before. The thing that I think we need to bear in mind is the number of Plan 2 graduates is getting bigger every year, has been getting bigger every year. They are millions of voters, and they're likely to vote. Students don't always vote. Graduates, well-educated graduates, tend to vote. And I do just wonder, there was an election in New Zealand, this is a really nerdy point, but an election in New Zealand in 2005 that the Labour Party in New Zealand won partly on the back of promising to abolish interest rates on student loans. That was over 20 years ago. Interest rates in New Zealand have not come back. There have been right-wing governments in New Zealand since, and the right-wing governments have said, we'd like to introduce interest on loans again, but we know politically it's not a popular thing to do, so we're not going to do it. So there are countries that have got rid of the real interest rate. I think what I personally would like to see is it sensible to have 5, as I say, and maybe a sixth one coming down the track, different repayment systems. Maybe we should start with a blank sheet of paper and look at all your parameters of fairness and see whether there is a better system out there to be designed. But we mustn't lose some of the positive features of what we've got.
Great. Kate, what's your prediction?
I don't have a prediction of what's going to happen. I think if the answer is start with a blank sheet and look at what should have happened to the previous cohorts of graduates and consider moving them onto different terms, that would be a huge and very complicated accounting exercise. I guess, do you want to just, if you're a campaigner on this, would the ask be to not put interest on loans in future, or would it be to wipe historic interest? And then you start getting into real credit. People who have already fully repaid their loan, should they get a refund? I mean, like the kind of complexity is I think daunting.
It's absolutely true, of course. Could I just make two other points? The first of which is that the system, we spent a lot of the morning talking about Plan 2 loans designed in 2012. And the system, the Plan 2 loans now are very different to how they were then. So I will still fight for the parameters of what we set in 2012 because I think they make a lot more sense. And the second thing is, all this chat about graduates has taken the spotlight off students. And students currently, yes, they're taking out the tuition fee loans of £9,500 a year. They're also taking out maintenance loans of up to about £10,500 a year. £10,500 is not enough money for a student to live. Sounds like a lot of money if your bank account has got £10,500 in it. But once you've taken into account typical rents for students, typical living costs for students, typical travel costs, food, all of that, then actually you find students need about double that to live, about £20,000 a year, some work we did with the University of Loughborough. And so I do hope that these conversations are not all about graduates. They also need to be about students.
And actually, even broader than that, and we haven't got time for this today, but there's also lots of broader questions about university and the value of university and good quality courses and courses that make people happy and all those broader things that Kate and colleagues are working on. So you never want to look at something nicer. And the further education, right? And for all the people who aren't going to university, what's the outcome for them? So there's always a much broader set of issues that this should be in the context of that. But let's stop there before we start a whole new conversation about other things. Thank you, Nick. Thank you, Kate. I suspect that student loans debates are going to keep rumbling on, if not for months, for years to come. They are complicated systems. The systems have changed a lot. We have come a long way from a world in which the government paid for most of higher education. We've also come a long way in terms of how many people go through higher education. It's a much bigger thing nowadays. I think it's one takeaway from all this conversation. It's that there isn't one definition of what's fair here. Ultimately, somebody has to pay for higher education. If it's not the graduates themselves, will it be other graduates, other generations? Will it be non-graduates? How are we going to share the burden of higher education is the fundamental question underlying all of this. And different choices about the kind of weedy parameters we've been talking about, whether it's thresholds or repayment rates, those are the things that are going to determine how the cost of that is spread across different groups. And we shouldn't forget that actually there are some nice features of our system. Other countries have systems that are much tougher. The fact that we have income-contingent loans that mean you don't start paying back unless and until you have a certain amount of income means you're not in a situation with a mortgage-style loan, for example, where you have to pay back regardless. So in all the debate about how the system could be better, we shouldn't remember that there are nice features of it. But on that, let me say thank you again to Nick and Kate. Thank you to all of you for listening. If you like this episode, please do share it with your friends, maybe with a student or a graduate, and consider subscribing. And if you want to become a member and support this work and others, you can do so for as little as £10 a month. You can check the link in the episode description. Thank you.